Hi, I'm Nicole and I'll be covering on the collapse of Signature Bank. So Signature Bank, founded in 2001 New York, served privately owned businesses, law, real estate and data crypto. By end 2022, it ranked 19 among US banks by S&P Global with 110.4 billion assets and 88.6 billion in deposits. So from 2020 to 2021, the bank saw rapid growth driven by pandemic stimulus, flight to safety and crypto demand. Assets doubled in 2020 largely from uninsured commercial clients. So in 2018, Signature pivoted from traditional lending to three niches: digital assets banking group, capturing crypto clients, the Signet blockchain payment platform, allowing 24/7 USD transfers and fund banking, offering capital call facilities to private equity firms. So most post-2020 loan growth actually came from fund banking, with an 8-fold growth by mid-2022, far outpacing other segments like real estate. While this pivot diversified group, it introduced major risks, especially in liquidity and deposit concentration, that contributed to the bank's collapse. In 2022, the Fed raised interest rates by 4.5% to combat inflation. This led depositors to seek higher yield alternatives, shrinking Signature's deposits. At the same time, borrowing costs became costlier, forcing greater reliance on collateralized borrowings and heightening liquidity risk. In this section of internal structure and culture, we will focus on the role of board, senior management, and the competency of personnel. The board is meant to set strategic direction and risk appetite. Instead, Signature's boards endorse risky growth, raising crypto deposit caps from 10% to 35%, despite a declared low liquidity risk appetite and repeated examiner warnings. This reflects a passive oversight culture where they failed to act when risk thresholds were breached, did not enforce accountability, and neglected forward-looking supervision. Senior executives are expected to manage daily operations and ensure that risk systems evolve with institutional complexity. Signature's senior management was described as reactive rather than proactive to regular concerns, and prioritized rapid growth in digital assets and private equity lending without developing risk controls. Decision-making was concentrated in informal executive groups, bypassing formal committees, where committee charters even allowed unchecked authority. This fostered a culture where compliance became a box-ticking formality rather than a strategic priority. At Signature Bank, the second line of defense was often sidelined. Persistent issues like BSA, AML, compliance, and model risk remained unaddressed across multiple exam cycles. The bank also failed to implement effective issue tracking processes, causing delays in remediation and a lack of accountability across departments. As for the third line of defense, the internal audit failed to escalate repeated control failures. Overall, control functions were pressured to align with growth goals, undermining their independence and effectiveness. Now moving on to risk drivers. Signature Bank's funding model was dangerously concentrated on uninsured deposits, forming 90% of total deposits and 72% of total assets by end 2022. These large confidence-sensitive deposits, mostly above the FDIC insurance limits of $250,000, came from mid-sized firms and institutions. During periods of market panic, such depositors are more likely to withdraw rapidly, exposing banks to severe liquidity stress, as most of their assets are very dependent on this small pool of very large depositors' confidence. By the end of 2022, 60 clients each held over 250 million, together accounting for 40% of total deposits. Even more alarming, just 4 clients held 14% of total assets, with 3 linked to crypto. This created a clear concentration risk. Management believed that these clients were sticky and unlikely to withdraw, but failed to validate this with stress testings of run-off models. Instead, private client groups were incentivized to attract large depositors. This poor liquidity risk leaves the bank dangerously exposed. Signature Bank's aggressive expansion into digital assets did backfire during the 2022 to 2023 crypto winter, as major crypto firms like Terra USD, Celsius, Voyager, and FTX collapsed, and eventually Silvergate as well. It dragged Signature with it due to its tight association with the crypto sector. By late 2022, Signature held 17.8 billion, or 20% of total deposits, in digital asset-related accounts. These were concentrated in crypto exchanges, stablecoin issuers, and mining firms. When confidence collapsed, these clients withdrew funds, causing 62% of Signature's 70.6 billion deposit outflows. While Signature Bank's expansion into crypto appeared innovative, targeting an underserved niche with its Signet blockchain platform, Signature failed to assess whether it had the internal capabilities to manage crypto-related market and reputational risk. So, as seen, Signature Bank's close ties is evidenced by stock price closely mirroring the downturn in the crypto market. Signature became a target of negative media attention, including money laundering allegations and comparisons to Silvergate. This reputational hit, combined with the collapse of Silicon Valley Bank, triggered a crisis of depositors' confidence and accelerated the bank's run. Signature's collapse did not happen in isolation. In early March 2023, Silvergate and Silicon Valley Bank both exposed to volatile sectors filled within days. Their downfall heightened systemic risk perception. Silvergate's liquidation announcement on March 8, followed by Silicon Valley Bank's failure on March 10, sparked panic withdrawals across similarly risk-profiled banks. Despite efforts to differentiate itself, Signature Bank was often seen as a similarly vulnerable due to its heavy reliance on uninsured and crypto-related deposits. On March 10, Signature lost 20% of its total deposits. Regulators confirmed that this was a liquidity-driven crisis triggered by contagion effects and not immediate asset insolvency. Moving on to the responses of Signature Bank's management before and during the crisis. Between 2019 and 2022, FDIC repeatedly warned Signature about liquidity stress testing, deposit concentration, and internal control gaps, yet management treated these as box-ticking exercises. Despite 92% of deposits being uninsured, executives believed client loyalty would prevent outflows, dismissing historical comparisons made by regulation to Washington Mutual and ED Bank. This misplaced confidence violated Basel Principle 14 on stress-tested contingency funding plans, as the bank failed to diversify funding or revise depositors' behavior assumptions under worsening external conditions. Now, during the crisis, management delayed action. They approached the Federal Home Loan Bank too late and attempted to pledge ineligible capital call loans at the Fed's discount window, despite knowing that they won't be accepted, which severely limited its ability to meet withdrawal demands during the bank run. They also misstated liquidity positions, underreported pledged assets even after regulatory warning. The bank lacked a functional stress-tested contingency funding plan, which is a key Basel Principle 14 requirement. Ultimately, this exposed their weak asset liability management to convert assets to cash or adjust its funding strategy fast enough in a rising rate environment, accelerating the bank's collapse. Thank you.